Welcome to your deep dive. We are tackling a titan today, a company so fundamental to the global economy that its performance really dictates the direction of the entire tech sector. Microsoft, ticker MSFT. And this isn't just a company synonymous with personal computing anymore, it's arguably the foundational digital infrastructure utility provider for the modern world. But here is the critical question we are here to answer for you today. Is it a great investment right now?
That is the mission, and it's a complicated one. You are really asking if the market's pricing reflects reality or just, enthusiasm. Our approach is rigorous. We are taking a decade of MSFT financial data, their very latest quarterly report, that's Q1 fiscal year 2026, and running it all through a really demanding deep value checklist.
So the standards inspired by Benjamin Graham and Warren Buffett.
Exactly. We're applying those time-tested high standards to see if the company's undeniable high quality justifies its current price tag, which is significant. We need to move beyond the headlines and examine if there's any true bargain opportunity left, or if every successful future outcome is already priced into the stock.
And as always, we are relying on detailed financial research and cross-validated data to give you the most granular view possible of Microsoft's shift. That shift from a legacy software giant to what we might call the AI infrastructure utility of the future. This is your shortcut to understanding the biggest financial pivot of the decade.
Exactly. And before we unpack those absolutely monumental numbers, a crucial point of context and a disclaimer derived directly from the source material. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content you are about to hear is for educational and informational purposes only and does not constitute investment advice. Please conduct your own due diligence with a licensed financial advisor before making any investment decisions.
That's absolutely critical.
And on a related note, if you're looking to track the overall market temperature and sort of gauge exuberance, we welcome you to search and download the iOS app Buffett Indicator from the Apple App Store. It's a great tool for, getting a feel for market sentiment.
A superb tool for understanding the broader environment. Now let's jump right into the latest performance report. Okay, let's unpack this Q1 FY 2026 report. Microsoft delivered what the sources unanimously describe as a resounding beat. This quarter was the litmus test, right? The quarter that had to prove definitively that their AI-first strategy wasn't just talk, but actual monetization. The headlines scream success. What were the absolute headline numbers that signaled this strategic pivot is delivering?
Well, the top-line figures were genuinely staggering, even for Microsoft's massive scale. We're talking about a multi-trillion-dollar company achieving growth rates typically reserved for, much smaller, nimbler startups. Revenue hit $77.7 billion for the quarter.
$77.7 billion.
Yes. To put that in perspective, that's an 18% increase year over year, or 17% in constant currency. High growth at a colossal scale is an extremely difficult feat to sustain, yet they are doing it.
And crucially, the profitability metrics demonstrated that they still possess that classic software operating leverage. It wasn't just top-line growth fueled by excessive spending.
Absolutely not. The operating income surged even faster than revenue, rising by a powerful 24%. This is the critical sign of quality for a software giant. It's operating leverage. It means that once their infrastructure is built out, every incremental dollar of revenue is extremely profitable because the cost of delivery for another software license or cloud seat is near zero.
So they're adding revenue far faster than they are adding fixed costs. That's what drives the margin expansion.
That's the hallmark of a high-quality, scalable business.
And the bottom line, the earnings per share, the EPS.
Diluted EPS came in at $3.73. That is a massive bottom line for a single quarter. However, the sources flag a specific, highly relevant financial detail hidden within that EPS figure, a drag on profitability. Even that robust EPS figure included a negative impact of 41 cents per share.
And that 41-cent hit was strategic, wasn't it? It wasn't an operational mistake.
Precisely. That negative impact was driven primarily by equity losses attributed to the company's deepening strategic investment in OpenAI. They're essentially betting aggressively on the future AI ecosystem. This detail shows you just how crucial the AI pivot is. Microsoft is willing to take a significant quantifiable hit on the profit and loss statement today, accepting volatility in their net income to ensure future dominance.
It's a calculated long-term sacrifice.
It really is.
This perfectly transitions us to the core identity of the business today. The financial researchers describe Microsoft as functioning as a diversified technology conglomerate, positioning itself effectively as a tax on global corporate productivity. Can you unpack that analogy and break down this critical triple threat business model for us?
That tax on productivity analogy is incredibly accurate because virtually every employee in the corporate world, from the biggest multinational bank to the smallest startup, uses Microsoft software to do their job, and they pay a recurring fee for that privilege. Their business is fundamentally split into three major segments, and understanding their proportional revenue is key to grasping the scale of their transformation.
Let's look at the breakdown. What defines these three pillars?
Okay, first you have intelligent cloud, which is now the dominant segment. It brings in the largest piece of the pie, about 32% of the total revenue. This segment is the future. It includes Azure, Windows Server, SQL Server, GitHub. This is infrastructure, data, and developer tools.
Okay, the engine.
Right. Second, productivity and business processes. That accounts for roughly 34% of revenue. This is the classic cash cow that turned into a compounding machine. Office 365, LinkedIn, and Dynamics 365.
So those two segments alone account for roughly 3/4 of the revenue, representing that cloud-first, subscription-based future.
Exactly. And finally, the legacy division, more personal computing, is about 24%. This covers Windows license fees, Xbox gaming, Surface hardware, and their search advertising revenue. While it's still massive, it is now the smallest and slowest growing segment.
The intelligent cloud, the Azure story, is clearly the engine we need to focus on. What kind of growth momentum did that show in Q1?
It remains the growth engine. It grew 20% in the quarter. But the long-term scale is the real story here. The reports show that Azure revenue surpassed $75 billion in fiscal year 2025 alone. That demonstrates an astonishing 34% annual growth rate over the prior year. This is where the AI monetization truly lives. When an enterprise signs up for a Copilot subscription or begins building AI models, that scales directly with their consumption of Azure.
Azure is their pipeline into the future corporate wallet.
That's a perfect way to put it.
Now, we have to talk about customer scale. The penetration into the corporate world is what makes this recurring revenue so sticky and predictable. It provides incredible financial stability. How wide is their reach?
The reach is what makes Microsoft structurally different from almost any other company. Let's start with the knowledge worker. Microsoft boasts over 400 million paid commercial seats for Microsoft 365.
400 million, that's not a rounding error.
No, it's a vast majority of the global white-collar workforce paying Microsoft a recurring, sticky subscription fee simply to do their day-to-day jobs, to email, to spreadsheet, to communicate.
That's the baseline, the immense foundation. What about the heavy hitters, the foundational enterprise clients?
Azure is utilized by a stunning 85% of the Fortune 500. And we're not talking about casual trial usage here. Azure serves as the actual digital backbone, the infrastructure, data storage, and compute power for the world's largest, most demanding corporations. When you consider this kind of deep integration, it leads directly into the critical point about their competitive advantage, or what Buffett calls the economic moat.
The moat analysis. If we're judging this company by high-quality value standards, a wide economic moat is non-negotiable. Microsoft appears to have built a fortress, not just a ditch. What are the three primary pillars of that defensibility?
There are three interlinked strategies that create an almost insurmountable barrier for competitors. The first is high switching costs. Think about an enterprise that is deep into the Microsoft walled garden. They run Windows on all their devices, use Azure for infrastructure, Teams for communication, Office for documentation, trying to switch that entire ecosystem. It's operationally and financially prohibitive.
The friction is just too high. The risk of downtime or integration failure is too great.
It effectively locks customers in. It's inertia weaponized.
Once they have that deep integration, the customer is essentially permanent unless something dramatically disruptive happens. What's the second pillar?
The second pillar is the classic network effect. This applies particularly strongly to their own platforms like LinkedIn and GitHub. These platforms gain intrinsic value with every new user who joins. More developers on GitHub make it a better tool for the developers already there. More professionals on LinkedIn make it more valuable for recruiters.
So the utility of the platform increases exponentially with scale, making it self-reinforcing. And the third moat pillar is the most relevant to the new AI era and perhaps the most aggressive one they are currently building.
This is the cost advantage derived from scale, which really means a capital expenditure moat. The barrier to entry in the frontier AI infrastructure space is just astronomical capital investment. Microsoft is using its immense cash flow to pour billions into infrastructure data centers, specialized in NVIDIA GPUs, custom silicon. This massive capital spend, or CapEx, which we will detail in a moment, acts as a financial fortress. By spending so much so fast, they prevent smaller challengers, even well-funded ones, from competing.
The growth is undeniable, the moat is formidable. We've established Microsoft as a wonderful business in structural terms. However, here's where the investment thesis gets truly complicated, and where we move from quality analysis to risk assessment. The cost structure is changing fundamentally. The sources highlight a major, new, almost existential financial risk: the AI capex wall. What exactly is this financial dynamic, and why is it currently creating so much investor anxiety?
The AI capex wall is the physical, financial manifestation of the AI arms race between the hyperscalers, Microsoft, Amazon, and Google. It refers to the massive, unprecedented surge in capital expenditures, the spending on physical infrastructure like data centers and specialized chips. That is required not just to compete, but to maintain leadership. It's a high-stakes bet that forces companies to rapidly consume capital.
We need to put a number on this massive spending. How big was the scale of this capital expenditure surge in the latest quarter, Q1 FY 2026?
The number is astounding. Capital expenditures hit a staggering $34.9 billion.
$34.9 billion in a single quarter.
In a single quarter. This is an amount that would make the entire GDP of some small countries blush. To give you the context required to understand the pivot, annual capex was $44.5 billion for the entire fiscal year 2024. Just a decade ago, in 2015, their annual capex was only $5.9 billion. This surge reflects an unprecedented scale pivot. Microsoft is effectively investing almost a quarter's worth of revenue into infrastructure in just 3 months.
That comparison, going from $5.9 billion annually to almost $35 billion in one quarter, fundamentally alters the financial DNA of the company. It transforms them, at least temporarily, from an asset-light software business into a heavy utility infrastructure builder. Why does this scale create such anxiety around return on invested capital, or ROIC, for long-term investors?
The anxiety stems from the immense pressure on the return on investment. When you spend $35 billion, the market demands rapid, high-margin revenue growth immediately to justify that spending. If this infrastructure spending, these billions in depreciating data center assets, is merely a sustaining innovation.
Meaning it just helps them keep existing customers and stops them from migrating to competitors.
Right. Rather than generating entirely new, high-margin revenue streams, then the math gets ugly. The depreciation costs from all these assets could weigh heavily on earnings for a decade, suppressing profitability.
This sounds like a financial cycle we've seen before, where capital deployment outpaces immediate revenue realization. The source material draws a very powerful historical analogy here, doesn't it?
It does, and it's a terrifying analogy for cautious investors. The late 1990s telecom fiber boom. During that era, telecom companies poured massive capital into building fiber networks globally, convinced that the internet explosion meant immediate, limitless returns.
But what actually happened?
What happened was massive overcapacity. They built infrastructure faster than demand materialized. The result was huge asset write-downs, years of delayed profitability, and a decade where those depreciation costs dragged heavily on earnings and suppressed stock prices. Investors are concerned that the massive AI capex could potentially create a similar scenario.
So the company is spending this money based on projections of what future AI consumption will look like, but the market is demanding results based on current consumption. What's the short-term paradox arising from this investment frenzy?
The paradox is fascinating. Ironically, the immediate growth of Azure AI is not demand-constrained. It is fundamentally supply-constrained. Microsoft literally cannot build data centers fast enough or acquire enough NVIDIA GPUs to meet all customer requests for AI compute power.
That's a bizarre but important bottleneck. It means the capex wall, ironically, is a temporary ceiling on short-term revenue upside. They are having to turn away or defer potential immediate business because they don't have the physical capacity yet.
Exactly. This incapacity to fulfill immediate red-hot demand is what likely contributed to earlier reports about recalibrating aggressive AI sales targets. It's not a lack of interest from customers, it's a lack of physical supply. The $35 billion is going towards solving this supply problem. But until that capacity comes fully online, this high capex spending will be visible on the balance sheet before the corresponding high-margin revenue appears on the income statement.
Now let's look beyond these financial dynamics. What are the other long-term risks, the external non-financial factors that could permanently impact the business model?
We identified 3 major external long-term risks that need detailed consideration. The first, and most familiar, is regulatory and antitrust risk. Microsoft's sheer size and market dominance put it squarely in the sights of every major global regulator, the FTC in the US, the EU Commission, and the CMA in the UK.
What are the specific pressure points today that regulators are focused on?
The scrutiny is intense across the board. They are looking at the forced integration of Teams into the Office 365 bundle, which some argue is anti-competitive. They are scrutinizing the massive acquisition of Activision Blizzard and, of course, the incredibly close strategic partnership with OpenAI. A forced remedy from any of these bodies could dismantle the core integration strategies that make the Microsoft ecosystem so sticky and profitable.
The second major long-term risk relates directly to the AI core business, and it is a massive, unknown legal liability.
That is new legal liabilities concerning data sovereignty and copyright. The entire legal foundation of generative AI is being challenged globally, particularly over the practice of training large language models on copyrighted data scraped from the internet. This is a crucial, unsettled legal question.
Is this just a theoretical risk that lawyers are discussing, or is it manifesting in the real world?
It is absolutely manifesting. We're seeing major lawsuits from authors, artists, news organizations. Crucially, the source material notes that shareholder proposals are demanding AI data sourcing accountability. This indicates that institutional investors are already wary of unquantified, potentially massive legal risks. If courts rule against current training methods, Microsoft could face billions in legal liabilities and damages.
And finally, the third risk brings us back to profitability, but this time it is structural. Margin pressure.
This is a direct structural challenge arising from the CapEx wall. AI queries and services are structurally lower margin activities than selling traditional SaaS software. Why? Because of the immense computational load and the higher energy costs. This means that as AI revenue grows as a proportion of total revenue, the consolidated gross margin percentage is dipping. Q1 FY 2026 showed a slight but measurable dip in gross margin to 68%. This compression is a tangible sign that the shift to AI is more capital and energy intensive.
That is the core conflict, then. The company is spending like a utility to ensure future dominance. But in doing so, it is structurally altering the hyper-profitable, capital-light business model that gave it such high margins in the first place.
Precisely. They are trading peak margin for maximum scale.
The risks, the CapEx wall, the regulatory scrutiny, the copyright liability are real, but we cannot ignore the decade of financial success that earned Microsoft this premium valuation in the first place. We need to look at the historical table, the decade of transformation from fiscal year 2015 through the trailing 12 months of 2025 to truly understand why the market is willing to pay such a high premium today.
This historical table tells the definitive story of the Nadella-era transformation, and it is a study in financial excellence. The core insight here is the dramatic decoupling of revenue growth from profit growth.
Walk us through that stunning margin expansion story.
From 2015 to 2024, revenue grew approximately 2.6 times, from around $94 billion to $245 billion. That translates to about a 13% compound annual growth rate, which is solid. But net income, the actual bottom line profit, grew a staggering 7.2 times over the same period, soaring from $12 billion to $88 billion.
7 times the net income growth on only 2.5 times the revenue growth. This margin expansion is the entire investment thesis for the last decade summed up in 2 numbers.
It absolutely is. It demonstrates the immense power of the strategic pivot towards recurring, high-margin cloud and subscription services like Office 365 and Azure. This focus on margins saw operating margins expand from 19.4% in 2015 to a stellar 44.6% in 2024.
And their ability to convert revenue into profit is outstanding. The net margin is truly exceptional.
It is. Net margin currently sits at a remarkable 35 to 36%. Think about that number. In FY 2024, Microsoft earned 36 cents of pure profit on every single dollar of sales it generated. That level of margin excellence is almost unmatched.
Margins are crucial, but the true sign of a quality business is its ability to generate cold, hard, unrestricted cash. How does the free cash flow story look over the decade?
The free cash flow machine is perhaps the single most impressive metric. FCF grew from $23.7 billion in 2015 to $74.1 billion in 2024 and reached $78 billion on a trailing 12-month basis. Crucially, the FCF margin, the percentage of revenue converted directly into free cash flow, is consistently outstanding, averaging 30% in recent years. This easily beats the traditional deep value threshold of 5%.
When a company generates that much excess cash, tens of billions a year, management's capital allocation strategy becomes paramount. What does Microsoft management do with all that cash, and how friendly are they to shareholders?
Microsoft is highly shareholder-friendly, operating a twin engine for returning capital. First, the dividend. They have demonstrated immense consistency by increasing their dividend for 19 consecutive years. They paid out $24.1 billion in the last 12 months alone.
And then there's the buyback program, which is arguably even more impactful than the dividend.
Absolutely. They maintain one of the S&P 500's most aggressive share buyback programs with a current standing authorization of $60 billion. Critically, these buybacks have tangibly reduced the share count over the decade, shrinking the outstanding shares from about 8 billion in 2015 to 7.4 billion in 2024. This systematic reduction is a powerful financial engineering tool that significantly boosts earnings per share.
Let's shift our focus to the leadership team. The sources universally praise the management team, led by Satya Nadella. How much of this radical success is attributed to the cultural and strategic transformation led by Nadella and CFO Amy Hood?
Nearly all of it. Satya Nadella, CEO since 2014, is credited not just with identifying the cloud opportunity, but executing the profoundly difficult cultural and strategic pivot. He fostered a cloud-first, AI-focused culture, embracing open source and breaking down the internal silos that once plagued Microsoft. CFO Amy Hood is the financial architect responsible for the disciplined cost management and the aggressive capital return policies.
And how aligned are they with shareholder interests? Do they truly have skin in the game when it comes to the long-term stock performance?
They do, and their compensation structure ensures alignment. Nadella's total compensation for 2025 was nearly $96.5 million, heavily weighted toward performance-based stock awards. This means his compensation hinges on the stock continuing its upward trajectory. While he and Hood are noted as net sellers of stock received as grants, which is a common practice, their personal wealth remains heavily tethered to MSFT's long-term performance.
Speaking of long-term holders, the source material contained a fascinating and perhaps worrying nugget of data regarding the activity of certain smart money investors in the recent past. The activity of the profit takers.
This is a critical data point that requires serious reflection for any potential investor today. The Q3 2025 data shows a noticeable cooling among some prominent long-term holders, the kind of investors who rode the stock up for years and now feel the valuation may be overheated. The most significant action was taken by the Bill and Melinda Gates Foundation.
How massive was that reduction?
They sold 17 million shares. That's nearly 65% of its entire stake in Microsoft.
Like 65%?
Yes. Think about that. This foundation, which is intimately familiar with the company, decided to sell almost two-thirds of its position after the stock's massive run-up.
Selling two-thirds of a multi-decade holding suggests that these long-term institutional investors believe the reward no longer justifies the risk at the current valuation, regardless of the company's quality.
That is the most likely interpretation. They are sitting on massive unrealized gains, and they are rationally taking profits and managing concentration risk. It is not an indictment of Microsoft's operational quality, but it is absolutely a flashing red warning sign about the stock's current price.
We have established beyond a doubt that Microsoft is a compounding machine, an absolute powerhouse of quality. Now we apply the final, rigorous test, the Buffett-style filter, separating company quality, where Microsoft excels, from the stock valuation, where the investment decision is made. This is the moment of truth where we see if the quality is available at a reasonable price.
And this checklist is designed to find companies that are both high quality and cheap enough to offer a margin of safety. As we go through this, you'll see a stark division. The company achieves near-perfect quality scores, but the valuation metrics fail spectacularly. It's the classic, wonderful company at a terrible price dilemma.
Let's start with profitability and efficiency. The quality check. First, gross margin greater than 40%.
Pass. Consistently hovers around 69%. Elite.
Okay. Net margin greater than 20%.
Pass. Currently sitting high at 35 to 36%. Superb efficiency.
Return on equity, the 10-year average, greater than 15%.
Pass. Microsoft's ROE has consistently averaged over 30% in recent years. Exceptionally efficient use of shareholder capital.
Return on invested capital, ROIC, 10-year average, greater than 12%. This is the big one.
Pass. Their ROIC consistently ranges between 24 and 30%. A benchmark of 12% is excellent. 30% signals an almost impregnable competitive moat.
Now here's the metric that reflects the changing business model. Depreciation divided by gross profit, less than 10%.
Minor miss. This is where the AI CapEx wall first appears. Depreciation is currently running around 11.7% of gross profit. A decade ago, this was an easy pass. This slight miss today reflects the high capital intensity required for the massive cloud and AI infrastructure build-out.
So 4 clear passes and 1 minor miss due to the AI pivot. Let's move to balance sheet safety. Debt to equity less than 0.5.
This is an exemplary pass. The ratio is exceptionally low, around 0.12. This is a fortress balance sheet with minimal reliance on debt.
Interest coverage, greater than 3 times.
Pass. Coverage is not just greater than 3, it is astronomically high, sitting around 37 times in FY 2024. No practical debt servicing issues.
Now here's a metric that often trips up hyper-efficient tech companies. Current ratio greater than 1.5.
Fail. But this is an instructive failure. The current ratio is around 1.35. While still fundamentally healthy, it falls short of the conservative value benchmark of 1.5.
Wait, you're saying a company with $78 billion in free cash flow is technically failing a safety test? Isn't that just pedantic?
That's a great question. It is a technical failure, not a sign of financial weakness. The reason is simple. Microsoft doesn't hoard cash. Instead of keeping a huge buffer on the balance sheet, they immediately return excess cash to shareholders through those aggressive buybacks and dividends. So, technical fail, but contextually, it is an extremely safe balance sheet.
Noted. 2 passes and 1 technical strategic failure. Next up, growth and predictability. Free cash flow positive every year, and FCF margin greater than 5%.
Pass. We already established FCF margin is 24 to 33% annually, beyond outstanding.
Return on retained earnings greater than 12%.
Pass. The estimated return on the capital they retain and reinvest, largely into Azure, is well over 45%. They are superb capital allocators.
And earnings per share rising every year for 10 years.
Mostly pass. The overall trend is powerfully upward. EPS roughly quadrupled. However, there were minor non-operational dips in 2018 due to a tax charge and 2023 due to write-downs. Excluding those one-time events, the underlying earnings power has risen consistently.
Okay, on quality, safety, and operational excellence, Microsoft is a blue-chip champion. It passes 9 out of 11 rigorous tests. But now, we reach the section that defines the investment decision. Valuation discipline, the price check.
Prepare yourself. We are looking for clear, quantitative margins of safety, and we find none. First, price to earnings, or PE ratio, less than or equal to 15.
Fail. The current PE is approximately 33.7. This is well over the traditional standard and near the high end of Microsoft's own historical range.
You are paying more than double the standard price for every dollar of current earnings.
Next, price to book, PB, less than or equal to 1.5.
Fail. PB is approximately 12. Now, context is important here. This high ratio is common for asset-light software giants, but strictly applied, it fails the deep value test. You are paying 12 times what the tangible assets are worth.
Finally, the PEG ratio PE divided by the expected growth rate, less than 1.
Fail. This is the crucial valuation metric. Microsoft's PEG ratio is estimated between 2 and 3. Any figure far above 1 means the stock is highly expensive relative to its current and projected growth rate. The market is not just pricing in growth, it is pricing in accelerated growth for a very long period.
The final score is decisive. Microsoft is a wonderful company by every measure of quality. But it fails every single quantitative deep value pricing metric.
The takeaway is absolutely clear. The market has fully priced in the quality, the moat, and the expected success of the AI pivot. It's a gold-plated company, but it is not available at a bargain price.
So what does this all mean for the potential investor? The stock is not cheap. When a stock fails all the valuation tests, we need the discounted cash flow, or DCF, analysis to quantify exactly what kind of future cash flow the market is currently expecting. This allows us to find the theoretical fair price and understand the margin of safety or lack thereof.
The DCF analysis is vital because it strips away emotion and reveals the high-stakes gamble investors are taking on future growth. We start with the trailing 12-month free cash flow of around $78 billion as our base, and we run 3 highly sensitive scenarios to test how dramatically the perceived intrinsic value changes based on future growth assumptions.
Let's start with the absolute financial floor. Scenario 1, the no growth or stagnation case. This is assuming the company stops growing FCF entirely from today.
Right. This assumption helps us determine the underlying value of the company's established cash flows. Assuming 0% growth indefinitely and using our 10% discount rate, Microsoft's intrinsic value per share would be between $105 and $111.
And the necessary margin of safety buy price 30% below that.
That would put the buy price between $73 and $78 per share. The insight here is chilling. If MSFT were to stop growing tomorrow, the stock would be dramatically overpriced by about 75%. This confirms mathematically that the market's current valuation of $470 is based entirely on the expectation of significant multi-year future growth.
Next, let's move to the conservative scenario, or slow growth. This assumes the AI pivot fails to accelerate growth, and the company reverts to its historical lowest sustained FCF growth rate.
Historically, the weakest sustained FCF growth was around 3% annually. If we assume FCF grows slowly at this 3% rate for the next decade, the intrinsic value per share lands around $144.
144. That is still more than two-thirds below the current trading price. This means even a modest deceleration implies a massive overvaluation if you require a 10% annual return.
Exactly. If we use a slightly more generous historical low growth rate, say 10%, the intrinsic value jumps to about $340. Even then, the margin of safety buy price still lands you around $238. In short, based on conservative historical growth, the stock would need to be in the low 200s just to be a fair value.
This makes the risk very clear. Now for the final, most crucial test. Scenario 3, the nominal growth or AI success case. This is where we attempt to quantify the market's current optimism. What does the company have to achieve to justify today's price?
We modeled two optimistic versions here. The first assumes a simple continuation of the 10-year historical average FCF growth of 13%. That yields an intrinsic value per share of approximately $308.
308. That's a huge intrinsic value, but still $160 below the current market price of $470. So even the long-term average growth rate isn't enough.
Correct. Therefore, the market must be pricing in accelerated growth driven by AI. So we modeled the most aggressive, front-loaded AI success case we could justify from the research. We assume free cash flow grows at an accelerating rate of 15% for the next 5 years, then fades only modestly to 10% for the remaining 5.
That is a highly aggressive, optimistic forecast that requires the AI capex wall to pay off immediately and generate massive, sustained cash flow growth. What is the intrinsic value per share under this ideal scenario?
Under this most optimistic, aggressive AI success case, the intrinsic value per share rises to $479.13.
Wait, let me repeat that figure, because it's the linchpin of this entire deep dive. $479.13. And the stock is currently trading right around $470 to $474.
This is the critical defining takeaway. The current market price aligns almost perfectly, within a few dollars, with the most aggressive, optimistic DCF scenario. This model assumes the AI transition is a complete, sustained success and generates double-digit FCF growth for a full decade.
That means the market has priced in perfection. There is no room for error.
Exactly. When the theoretical fair value based on the most aggressive growth assumptions perfectly matches the current trading price, it signals that the stock offers literally zero margin of safety. If anything goes wrong, if regulatory risk materializes, if the capex wall takes longer to pay off, the stock is instantly overpriced. An investor buying today is simply betting that Microsoft will execute its most optimistic forecast perfectly for 10 years.
Which is a high-stakes proposition indeed.
It is. Remember that Buffett himself famously said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Microsoft is the wonderful company, but today's price is not merely fair. It is demanding absolute perfection. To summarize our comprehensive findings, we established that Microsoft is an elite quality business. It passes virtually all the rigorous tests for margins, debt safety, and compounding capital. It is, by all measures, an unquestionable, wonderful business. However, it fails every single quantitative value test. The market is paying a hefty premium, assuming a high teens growth rate for many years to come. At the current price near $470 per share, the stock offers zero margin of safety for the prudent conservative investor.
For you, the learner, this deep dive provides the classic essential distinction between a great company and a great stock. Microsoft is a compounding machine, a foundational digital utility, but today's analysis shows you are paying full, exuberant, AI success-driven price for that machine. This leaves little room for error if the AI capex wall anxiety, the fear of massive spending not translating immediately into massive high-margin revenue, turns into a growth reality check. You are buying high certainty, but at a very high price.
And that leads to our final provocative thought for you to consider. The question that will define the next decade for MSFT. Microsoft is currently investing a quarter's worth of revenue into capital expenditure, $35 billion in one quarter, to maintain its leadership. If the market's assumption is correct, it will be the utility provider of the next economic cycle, printing cash. But if the massive infrastructure spending required for AI becomes a permanent structural cost of doing business, can Microsoft's profitability ever return to the capital-light 40% plus operating margin structure that fueled its historic margin expansion? Or is the new reality one of lower margins but higher scale?
That is the multi-trillion-dollar question the market has seemingly already answered, but which remains untested by reality.
And finally, a crucial reminder. All analysis presented is based on publicly available sources and may be subject to revisions or differing interpretations. Remember, this content is for educational and informational purposes only and does not constitute investment advice. Please conduct your own due diligence with a licensed financial advisor before making any investment decisions. And once again, if you want to track the total market temperature, we welcome you to search and download the iOS app Buffett Indicator from the Apple App Store. It is a fantastic resource for assessing overall market valuation.